Hello, this is Susan Hayes, the Positive Economist, and this is the first of a series of videos called investinginyouth.com, introducing Wall Street to the classroom. How I always start off an explanation of the stock market is that it's very similar to a very, very big shop. That's really all that it is. But I like to go a little bit deeper than that, obviously. So the first thing that I do when I'm starting in a classroom explaining about this concept is I bring in a couple of bars of chocolate. And I hold up these bars of chocolate and I basically say, well, which one of these would you prefer? We'll take, for example, a Dairy Milk, a Kit Kat, a Moro, a Galaxy, like I have up here. Now you can either choose to bring in these bars of chocolate or simply use the graphics that I have supplied. And usually you get a very good reaction, I like this one or I like that one. And what I would always invite teachers to do is say, well, which would you prefer and why? Now, there may be various different reasons that they may choose a chocolate bar. For example, they prefer one, or there's more to eat in one looks nicer, one looks better, one tastes nicer, one costs more, maybe it's advertised and I'd like to try it. And why I talk about this type of thing is because when you choose a bar of chocolate in a shop, there are various different buying decisions that you make, but you make them instantaneously and subconsciously. When I walk into a shop, usually, and I want a chocolate bar, usually it's a Moro that I pick because I just like it, and that's that. So if I look and think about the whole shop analogy that I like to create, I have a couple of graphics on the right hand side. For example, Debenhams, Tesco's, Lifestyle, Sports, and when you think of a shop, there are a couple of characteristics that each one has. You can buy and sell in a shop. Now, ordinarily you can't sell in a shop as a consumer, but you can as a shopkeeper. It also has opening and closing hours, and as a consumer you are a price taker. Unless you can bargain, but we'll pretend that you can't in this case, you have to take the price that is being put to you. However, the particular shop where we leave the whole idea of a normal retailing experience of where we move to the stock market is that, first of all, you don't consume the item but attempt to make money out of what you buy in the stock market. I don't buy a particular stock just to use it or to consume it or to wear it or to eat it. I buy a stock with the idea in mind to make money out of it by selling it back at a higher price. In addition, I can't walk into the shop and test the goods. And nobody owns the shop. There is not one single person that owns the stock market. It is both that, it is a market. And nobody takes all the profits. There are millions of people who participate in this and basically give each other profits or losses as they go along. So what has chocolate and stocks got in common? Well, basically, they both involve similar buying decisions. Like I said, I pick up a Moro because I like it and I like the biscuits in it and I like the caramel in it, etc. And why would I buy a stock like Coca-Cola? Well, I might buy it because of its high dividend yield, because of its strong earnings power, because of its consumers and the amount of them, because of its profit pricing power. But each of these both involve decisions. Now, one of them, namely the stock, I would have to think more about and put more research into, but that is where the analogy would lie. And also, it must be noted that every single student that you have had, I'm sure, has had the experience of going into a shop and buying a bar of chocolate, and that's why I choose this particular one. So the stock market is a place that you can buy and sell goods, but in this case it's ownership of companies. There is a shopkeeper, but in this case it's called a stockbroker. It opens and closes. There are fixed times every day. Just for your own information, the UK market opens at 8 o'clock in the morning until 4:30 in the afternoon. The US market opens at 2:30 in the afternoon and closes at 9 at night. And you can't control the price. If Coca-Cola is being offered to me at $55, I can't change that. The market may move up or down, but I, as simply one participant, one buyer among the millions that trade in the stock every day, can't move the price on my own. So I am, in the economic term, a price taker. Instead of eating the produce, I can sell it back. So if I buy my shares in Coca-Cola, unlike buying a can of Coca-Cola, I can actually sell back that holding to somebody else at some point in the future. Now bear in mind, that point in the future could be a second later, it could be a week, a month, a year, a decade later, but I can sell it back as long as Coca-Cola is trading in the market. I can't walk into the shop, but I can window shop. So like I will be showing in a later video, I can set up my window shop, which would be my watch list, and I can buy and sell, and I can look at the produce and look at the prices, but I can't walk into it. I can't put on the stock and try it and walk around with it for a while. So like eBay, all I have is a window to operate with, and similarly, nobody owns this particular shop at all. So in this shop, what exactly can we buy? Well, how I like to do this particular exercise is to take an example. So we'll take, for example, McDonald's, a massive company. Bear in mind, on McDonald's I have sent out a PDF with analysis of the company, which you may use for your business studies students, your transition years, your economics and your accounting students. So if you do want a copy of that, please do send me an email. All my contact details are on www.investinginyouth.com. So we'll take McDonald's. So what do they sell? Well, in this case, they sell millions and millions of burgers and chips and everything else, but we'll just take burgers, taking one good. So they make billions, and how one person can have a slice of the action is simply buying a portion of that company in the stock market. Now, one stock or one share in McDonald's is going to mean an absolutely tiny percentage. So it's not that you're going to be becoming a major shareholder, but you would, since you are a shareholder of the company, in whatever percentage, have a claim on part of the earnings of that company, and naturally the dividends as well. So who can you buy? Well, I took some examples that your students would probably be very familiar with, like Nintendo, Marks and Spencer's, Sony, Nescafe, Next, and Disney. And that is the end of this video, which is the start of the module, What is the Stock Market? We will see you for the next one, which is Why Bother with the Stock Market? Thank you. Susan Hayes, the Positive Economist.